So yesterday we basically started talking about the different types, or not the different types of credit, but an introduction to credit, okay? And we talked about three pretty simple terms: principal, interest, and the actual definition of the word term. Does anybody remember what the principle of something was? If I go borrow money, what is the principle of that? No, we need to know this. What do y'all think? Look at your notes. It's in it. What does the word principal mean? What is the principal balance of something? Y'all remember? What's that? Yeah, it is the exact amount of money that is borrowed. So if I go borrow $3,000 today, my principal is what? $3,000. Okay. Now then, you got the word interest. Usually they put interest on you annually, so they do it by the year. And that is how much you're being charged for the right to borrow the money. So this is where your good, bad credit scores come in. If you have really, really, really good credit, are you going to have high or low interest? Low interest, because your credit's good, right? You built a financial history to where you've paid things off, everything looks good, right? And then the term. The term of something is the amount of time it takes to pay back. So if I take out a loan for 5 years, that's my term, 5-year term. If I mortgage a house for 30 years, it's a 30-year term, okay? Also yesterday we talked about secured and unsecured loans, okay? Now with a secured loan, what is required for you to get a secured loan? You have to put something up against it. Y'all remember? Collateral. And it could be many different things. Car, house, farm, could be a dirt bike. You know what I mean? It could be a lot of different things for collateral. So a secured loan, you have to have collateral. All right, now, if I don't pay a secured loan back, what would the lender, the person that let me borrow the money, do about that collateral? They're going to come take it, right? Because that's the amount of money that was financed. All right? Since it is a secured loan, is it safer for the lender to allow you to have the money, or more risky for the lender to give you the money? If you're putting something up against it, it's safer, right? Because he knows or she knows that you're more than likely going to pay this loan back because you have something against it, right? So with that being the case, what type of interest rate do you think you would get on a secure loan? Low or high? Lower one, right? And then an unsecured loan is basically the opposite of a secured one, guys. You don't have to have collateral. It's more risky for someone to let you borrow that money. Therefore, the interest rate would probably be higher. Does that make sense? Okay. So, and then I think the last thing we got to yesterday was the factors that determine the interest rate that will be charged. And basically, this is an individual by individual basis. Okay? So if you have a credit score that is a high score, you're going to get low interest. If you have a credit score that's low, meaning you've missed payments, you haven't paid things back, things of that nature, you're going to have a higher interest rate. So the better your credit score, the lower your interest. The loan itself, if it's high principal, meaning if I go borrow a lot of money, then I'm going to have a longer term. If my term is longer, my interest will be higher. I'm going to pay more interest on a term that's 30 years than what I would on a loan that's 5 years. Y'all got that? And then the situation in my life, like what's my employment history? Have I had a good employment history? Loans, the loan itself, is this a good loan? And then my total debt. If I'm borrowing 10 grand but I already owe 100,000 to somebody, lenders are going to be kind of weary of me. Okay? So that's kind of where we are as far as this credit stuff goes. Does anybody have any questions about it so far? Does that make sense? All right, so here's what we're going to do a little bit now. We got to talk about. Let me get it pulled up here and get it to function properly. The next thing we're going to talk about is a cosigner, and I'll pull my notes over to your side so you guys can see it. So we're going to talk about a cosigner. Now, does anybody know what I'm referring to when I say a cosigner? What do you think that is? First off, before you answer me, when you go get a loan for whatever it may be, right? When you have to fill out a 5-year term or a 10-year term, whatever, you're going to have to sign a bunch of documents saying that you're going to pay back that money with interest, right? And they're going to give you a monthly payment, and we figure it out from there. Now, with that being said, why would someone, or what is a cosigner? Let's do that.
Right. If you want to get a tattoo, but you weren't 18 years old yet, parents could co-sign.
Okay, that's one way. Yeah, you're right, but I'm looking for a different type of cosigner. Does anybody have another answer for that? You're absolutely right, Jason.
When your parent comes to sign it off saying you can borrow.
Yeah, but it doesn't necessarily have to be a parent, okay? So let me give you an example, and then you guys tell me what a cosigner is. Can we try that?
Yeah.
Okay, so let's say I heard Jace a minute ago say he wanted to go buy a new back tire for his dirt bike, okay? Well, for example purposes, let's say these tires are extremely expensive. Y'all with me? Well, when Jace goes to get this tire, it's going to cost him, let's say, $1,000. Now, I know that's not going to be the case, but let's just say it's the state-of-the-art tire that never goes flat. Y'all got me? So, Jace wants to buy this, but he doesn't have the money. So, Jace, they look up his credit, and let's say Jace's credit's not so good. Let's say that he's missed payments before. You know, he just had some bad luck as far as, so his credit score, you know, let's say if your credit score is perfect, it's 800. Well, let's say that Jace's is 400. It's pretty bad, okay? Now, they're still going to allow Jace to finance this tire, but they're going to make Jace put down what they call a cosigner in case he can't pay back that loan. And what that means is if you go co-sign for someone, and before I tell you what it is, guys, let me tell you this much. It's not a really good idea to ever do that. Okay? It's not a good idea to ever co-sign for anybody else, because here's why. Let's say Jace asked me to co-sign for him so he can get this tire. So I go in, I sign the papers with him for this $1,000. Now here's the catch with that. When I go in and sign those papers with Jace, if Jace doesn't pay that loan back, guess who does?
You.
I have to. I am putting a lot of trust in Jace, so I'm helping him get that tire. Let's say my credit's immaculate. Say I got great credit. So they're going to let him get that tire because I co-signed for him. Y'all got me? If he don't make those payments, guess who they're coming to get the payments from?
You.
Me. So if you co-sign for someone, you better really, really, really trust them. Now, obviously your parents is going to trust you, because if most parents will, because if you don't pay it back, they're going to beat you anyway, right? Whoop you or whatever.
Mm-hmm.
So, but later in life, think about it like this. Let's say I'm 45 years old and I want to put new windows in my home, and my credit stinks. Well, I'm going to have to get somebody to co-sign for me. Y'all understand that's very difficult to do, because you may have a best friend in the world. They're like, well, wait a minute. Now, if you don't pay this back, I'm on the hook for it. So let's make sure, you know, it can ruin friendships type thing. It can ruin a relationship you have with someone. So, beside of cosigner, let's put down that it is someone who agrees It is someone who agrees to take on the responsibility of repayment. It is someone who agrees to take on the responsibility of repayment. Now, I'm going to put you a little note here. Jot this down. You need to consider that your credit, and I'll explain this to you here in a second, will be affected negatively in a bad way, okay? If the other cosigner does not pay the loan. Okay, so here's what I mean by that. Let's go back to the example that I just gave you with Jace. Okay, if Jace doesn't make those payments, guess whose credit it's also going to affect?
Co-signer.
Mine, right? So I'm going to harp on him about the possibility of making sure that he makes those payments. I don't want to lose points off my credit because he's not doing what he's supposed to do. Does everybody get that? Does that make sense? All right, cool. Now, the last little part of this first section that we're going to do deals with variable and fixed rates. Okay? So right below this, write down the word variable rate. Now, if you remember in our little video yesterday, the surfer guy was talking about variable and fixed rates. Now, if I have a fixed rate, and what this is talking about is your interest, okay? If I go in and get a fixed interest rate, and let's say that interest rate is 2%, y'all got me? And I borrow money for a 30-year term. In year one, if I have a fixed interest rate, it's going to be 2%. Does that make sense? Year 10, it's going to be 2%. Year 20, it's going to be 2%. Year 30, it'll be 2%. It never changes. That is a fixed rate. Y'all understand that? A variable rate is one that will increase and decrease based on the federal interest rate environment. So it can go up and down. And there's a lot of factors that go into that. Okay? A lot of factors. So, beside of a variable rate, first thing I want you to know is we're talking about the interest that we would pay. The interest rate. All right? So we're referring to the interest rate. In a variable rate, this could increase or decrease depending on the federal interest rate environment. So what that basically means is if things are going really, really well, your interest will be low. You with me? If things start going a little bit shaky, your interest will rise. Your monthly payment on a variable rate term will fluctuate. This month it may be $50. Next month it may be $75. The next month it may be $110. The next month it may be $30. You see what I'm getting at? It can go up and down, okay? So, I would put down that monthly rates or monthly payments. Let's go with payments. Monthly payments could be higher or lower. They could be higher or lower depending on the change. And that is a variable, okay? Up and down. Think a variable is like a wave, up and down, okay? Obviously you want it to stay low, but sometimes it can get high, okay? And then the other type of interest rate, the variable that you get, or excuse me, the interest rate that you get is a fixed rate. Okay? And when it comes to a fixed rate, guys, the interest stays the same. The interest rate stays the same. Over the life of the loan. That's what I was talking about earlier. If I get an interest rate of 2% when I sign it and I get a fixed rate, it's going to be 2% the entire time I have that loan. Does everybody understand me? So those are the differences there. Okay? So does anybody have any questions about that? Makes sense? Alright. So here's what we're going to do next. Let me stop this video because we're going to start a new one as far as what the definitions give us, or the book's giving us.